Hello, good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA. I'm Kelvin Wong here, the Senior Market Analyst of OANDA Asia Pacific. So good morning to all. Today will be Tuesday, the 9th of January 2024. So before we start, let's take a look at the disclaimers slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so yes, so before we jump into that, the usual short-term technical outlook on the broad-based asset classes, that is ranging from the major stock indices, the major FX pairs, the two commodities, which is gold and WTI crude. Let's have a recap of what happened yesterday in terms of market performance, and as well as yesterday's key event and data that could potentially have an impact on the market in the shorter term perspective down the road. So firstly, performance of the market yesterday, within our expectation, we do those who actually followed our daily dose of market insights on Monday, we do expect a short-term recovery on the major US indices, which actually it took shape. So if you look at the benchmark US indices yesterday, overall from here, we saw the S&P 500 that actually rose 1.4%. The Nasdaq outperformed within our expectation, 2.11%. The Dow Jones Industrial Average slightly underperformed at 0.6%. The Russell 2000 1.9%. So if you look at the heat map of the S&P 500, looking at all the component stocks performance inside the S&P 500, we start to see a very strong outperformance on the mega cap stocks over here. All right, so very sure the Microsoft, the Apple, Nvidia up 6%, okay, a whopping 6%. Amazon plus 2.66%. So what we could see over here is that, number one, even though in terms of technical analysis perspective, yes, we may see price action oscillate within the short to medium term trend phase, but as long as the markets or the per se the Nasdaq 100 or the Dow Jones Industrial Average didn't break the 50-day moving average, it's actually a potential sign that the medium term uptrend phase on the major US indices still remains intact. And do not forget over here is that what's driving the forces of this we call it risk on medium-term behavior. Okay, I will stretch as medium term, ranging from multi-month to multi-week, is due to this liquidity easing condition in the global markets. So one way to actually decipher liquidity condition is by looking at a major benchmark long-term interest rate, which is the US 10-year Treasury yield. So if you look at the US 10-year Treasury yield, as per highlighted 2 days ago, this is one of the things that we look at to gauge whether there's a risk on or risk off effect on the market. Is if you look at the benchmark US 10-year Treasury yield, yeah, here we go. So if you look at the benchmark US 10-year Treasury yield, what we foresee is that the 4.06% level that we highlighted as a key medium-term resistance to watch or inflection zone to watch, we also confluence with the 200-day moving average as well. So this earlier push up at the start of the week that lead to that sell-off or underperformance of the Nasdaq 100, then what we could see over here is that on last Friday, it hit this inflection level at 4.06, and yesterday it did a bearish reaction of at 4.06 level that also correspond or trigger that risk on behavior in the Nasdaq 100 that led it to outperform the major US stock indices. So what we could see over here is that potentially given that this is a bearish reaction at this point in time, and if the 10-year US Treasury are going to inch downward, and especially reintegrating below the 50-day, the 20-day moving average that was taken out earlier last week, potentially we will start to see another renew we call leg of liquidity easing condition in the market, which also supports this ongoing risk on behavior in the major US stock indices. All right. So given the fact that there is a bearish reaction of the US 10-year Treasury at 4.06%, so the narrative now is more skewed towards the bullish side of the story for the major US indices. And do not forget over here is that on the FX story over here, we do start to see renewed dollar strength season out, fizzle out. That means, i.e., last week of dollar strength has more or less is more or less reached a tipping point to kickstart a potential resurgence of renewed dollar weakness. So this particular chart, which I highlighted yesterday, also also come hand in hand with this easing liquidity condition as depicted by the US 10-year Treasury yield spreading down to the 2-year as well. So if we were to highlight this 5-day performance, rolling performance chart of the dollar against the major currency, so what we could see over here is that the one that triggered this dollar weakness at the start of this week, which is yesterday, which I keep on stressing on our daily dose of market insight, will be the dollar yen. So if you look at the dollar yen over here, let me let the chart do a bit of refreshment first. Okay. Yes. Okay, so what we could see over here is that the dollar strength with the yen actually dissipated since hitting a peak of 3.3%. This is a 5-day rolling performance, so it rose every 5 day. So what we could see over here is that this was the dollar strength at the start of last week, means at the start of the year. Then thereafter, ex-post NFP data, which is a significant day because it's a key economic data. Then thereafter, the dollar strength dissipated, and we see renewed dollar strength weakness coming back into the play, especially hitting the dollar yen, which was the earliest strongest pair earlier on. So once the leader got hit, this is where it could potentially drag down the rest of the dollar, uh, 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 the rest of the major currency. That means, i.e., throughout the board, dollar weakness throughout the other major currency. Okay, so this was what we are witnessing right now. And also, if you look at this particular graph at the bottom of my chart over here is in fact looking at not the 2-year, the 10-year, because FX market tends to be to actually do intermarket correlation with a short-term perspective in FX market. Instead of using the 10-year differential, I will actually use the 2-year differential instead. That means, i.e., by looking at the difference between the US 2-year Treasury yield against the sovereign bond 2 years against the rest of the world, with the average of Germany, UK, Japan, Canada, Swiss, Australia, and China. So if you look at this perspective over here, this US 2-year Treasury yield premium shrinkage, I will call it, has started to actually string as well. So this is actually also supporting renewed dollar weakness coming back into the picture of the market. So i.e., what we could see over here is that easing market liquidity condition, there was see a slight uptick at the start of last week. So translate to risk on behavior in the major US stock indices, which also come hand in hand with renewed dollar weakness. Okay, this I want to stress. This is the key narrative right now that's taking shape, all right, in the market in terms of cross asset performance. Now, events now. Okay, events that took shape yesterday and as well as early this morning. So let me start with yesterday first. So over here at yesterday, there's actually a particular we call it a statement from a key PBoC official, that means the Bank of China. So the Bank of China official actually hint that there could be more potential easing on the reserve ratio cut by major Chinese bank, all right, over here. Okay, so due to the fact that it seems to me that Chinese policymakers are pretty much concerned about the weak sentiment in the China stock market and as well as the Hong Kong benchmark stock indices. So bear in mind that Hong Kong stock market has a direct correlation is what happened in China, given the very close linkage that between Hong Kong and China in the last 10 years or so. All right. So the point I want to stress out over here is this China and Hong Kong stock market right now at this point in time, there are other structural problem or structural weakness that causes them to be not taking part in this risk on behavior that was since late last year, where the dollar strength dissipated the liquidity condition starts to ease, where we start to see a kind of a major risk-on rally in the benchmark US indices spreading to the rest of the other ASEAN stock benchmark indices, as well as the European stock indices, where the DAX rose to all-time high. But the China and the Hang Seng Index is not participating in the risk-on rally. Why? Because of structural weakness in China. Number one, we still have the risk of a persistent deflationary spiral due to weak property prices, i.e., why weak property prices? Because the China top policymaker do not want to engage an all-out liquidity pumping scenario to actually revive the property market. Why? Because they do not want to have another round of bubble. That means they actually use targeted measures to actually ease off this differential spiral. So that's one thing. Second thing, there could be an uptick in geopolitical risk tension this year in China, given the fact between China and US, pardon me, given the fact that we do have a key event coming up in 2024, which is the US presidential election. So very likely, China, the presidential candidate will actually use China as a talking point again to drum out that national security risk that China will have with US and the rest of the world, and also not added the fact that the latest economic work plan seminar that was concluded in China in December, where top policymakers will decide what are the key economic priorities of China for 2024, which is, i.e., they're actually putting high-tech industrialization as a top priority over domestic, over what I call a push in domestic demand. That means they're going to actually use state resources to actually engage in high-tech industrialization. That means technology know-how that surround on semiconductor, Internet of Things, i.e. we have this EV as well, solar panel. So all these are actually will potentially lead to what I call a protectionist policy, as a protectionist policy with engaged by neon hawks US policy makers, especially when we start to see the drum up towards the second half of this year, where we much come closer to the US election. So given the fact that we know that sentiment is getting very weak in China. So as and when we may start to see various China officials coming out to give a bit of what I call dovish comment. So there was this dovish comment that was seen late yesterday after the close of the Hong Kong stock market. So he actually hinted that PBoC may use open market operation like medium-term lending facility and reserve requirement to provide strong support for reasonable growth in credit. Okay, so that actually give a bit of so-called a positive feedback loop into the local China stock market and the Hang Seng Index. So if you look at the Hang Seng Index right now, it's actually up, okay, 0.6%. Hang Seng Tech 0.4%, and the CSI 300, which is the benchmark China stock market index, is up marginally only 0.10%. Okay, so a bit of positive feedback loop after this so-called smoothing statement from these PBoC officials made yesterday. And also one thing I want to highlight over here is there's this Bostic speech. So Bostic yesterday is one of the much more rather less dovish Fed officials, I would say. He's from Atlanta, so it's the Fed chief of Atlanta region. Okay, so he says it's too soon to declare victory, and policymaker can let restrictive policy proceed over here. So I think this is not kind of a surprise to me, based on his usual characteristic of his past comments. All right. So, but most importantly, what we want to see is how market react expose this comment. So, what we could see, I share with you all the 10-year US Treasury yield has started to shape that bearish reaction of that 4.06% key inflection or resistance level. Okay. Then today, earlier on, we have the Tokyo CPI data release, which is one of the important metrics for BOJ to actually decide whether to normalize policy this year. That means removing their decade-long of negative short-term interest rate. Okay, so let me share the screen. Yep. Okay, let me put it in bigger. Okay, so we have this Tokyo CPI data. So what we could see over here is that cost push inflation has started to come down. Okay, so in Tokyo it's a bit different. In Japan it's a bit different. They have the core CPI. So core CPI only excluding food. Okay, so if you exclude food over here, it came within market expectation. It dipped down below 2.1%. year on year in December, from 2.3% year on year in November, and we in consensus of 2.1%. All right. So, but however, if we were to remove the cost push scenario for volatile items like energy, we have the core inflation, which is excluding food and energy. It actually maintained relatively high at 2.7% year on year. So, if you look at the chart of this CPI data, excluding cost push inflation measure, that means excluding energy and food, fresh food, you see that it still remain relatively high at a higher level of 2.7%. And if you look at the trend in the past 5 year or the past 25 year, it's actually at a 25-year high in terms of CPI data, excluding volatile items, fresh food, and energy. So all in all, right, what we could see over here is that yes, core inflation in Japan, that means that includes energy, has starts to come down, but that's more of a cost push measure due to lower energy prices that we see in Q4 last year. But however, excluding food and energy, the services side of the story of the CPI component has continued to be remains elevated. That means, i.e., it actually gives much more, we call it ammunition for the Bank of Japan to indeed start thinking of normalization or removal of their short-term negative interest rate policy possibility after March this year, because Japan, we call it a financial year, will end in March, and they will start a brand new financial year in April. And during March time, the union in Japan and together with the employers in Japan will start to negotiate their this year wage package. So if we start to see a substantial increase in wages during this employee union negotiation in the period of February to March over here, then we will potentially BOJ will have no reason to actually to maintain that potential short-term negative interest rate policy, given the fact that wages could actually potentially got to actually continues to rise to keep up with this elevated inflationary pressure in Japan that is excluding fresh food and energy prices. Okay, so these are the key events that actually take shape yesterday and this morning, and how does it shape the market going forward. All right, now short-term technical outlook. Okay, so now we jump into the short-term technical outlook of the various asset classes. So let's start with the FX market first. So like I mentioned earlier on, dollar weakness that is within our expectation. Start with the European currency. All right, euro dollar. Okay, so now let me expand my screen. Okay, euro dollar, no change. Price action continued to tick higher above the 20-day moving average, and also held pretty well at the 1.089 short-term pivotal support level that we have late last week. So still maintaining this level because price action didn't break the 110 figure level. That was I would say a near-term resistance, and also important. Why? Because that actually also saw that spike up exposed NFP data as well, then refusing to go up and start to trade sideways. But one thing positive is over here is that it managed to actually hover above the upward sloping 20-day moving average, giving a bit of signs of what I call bullish pressure coming back on the euro dollar pair. So 1.0890, no change, short-term pivotal resist support level to maintain that short-term bullish outlook. For sure, we need to have a clearance above 110 figure level. That means IE and hourly close above it will potentially ignite a much more pronounced, we call it a bullish tone to expose or to see the next intermediate resistance coming in at 110.60, followed by the swing high of 28th of December at 111.30. Only an hourly close below 108.90 invalidates this short-term bullish tone to see a extension of this minor corrective decline towards the 200-day and the 50-day moving average that is confluencing with the medium-term ascending channel from the 4th October 2023 low, now acting as a support at 1.082, also confluencing with the minor swing high of 8th of December and 12th of December, acting as a pullback support as well. Okay, sterling dollar. So sterling dollar over here almost the same as the euro dollar, but I expect that they are more bullish. Why? Because the price action has for sure left much as a further we call it up move above the upward sloping 20-day moving average. So given the fact that now it's actually flirting around with the last Friday swing high area at 127.60, almost about break above it yesterday before it came down to do a minor bullish flag configuration. So given the fact that it's much the what I call it, the rebound is much more pronounced when it hit on the 20-day moving average. So with that, I'll be much more confident to have a tighten key short-term pivotal support for today at 26.50. So I'll use 26.50, 12650 as my tighten key short-term pivotal support level on the sterling dollar. Okay, on the sterling dollar to maintain that short-term bullish outlook. An hourly close above 126.60 later on thereafter potentially could see a more pronounced move to test 128.20. Above it exposes the next intermediate resistance coming in at 129.40. If we see an hourly close below 126.50, then this short-term bullish tone will be negated to see a kind of very messy sideways movement to sideways downward movement to retest the 126 figure support level. All right. So i.e. net still maintaining that short-term bullish outlook on the sterling dollar, but it's given the fact that its configuration is much more bullish, like I mentioned earlier on how that pronounced bounce off the 20-day moving average. So we will use a tighten key short-term pivotal support for today at 126.50 to maintain this short-term bullish outlook on the sterling dollar. All right. So now Asia Pacific major currency. So let us start with the dollar yen first. So dollar yen for sure, what we could see over here is that the price action continue to inch downward, exposed Tokyo CPI data. So it really broke below this near-term support level at 143.75. So we will break down below this level. I will actually now lower down or tighten my key short-term pivotal resistance at 144.90 for today, which is the swing high, a minor swing high area, which was the high of Asia session high yesterday, 144.90. So as long as 144.90 tighten short-term pivotal resistance holds for today, potentially the dollar yen could see a further slide to at least retest 142.20 in the first step. Only an hourly close above 144.90 will negate this short-term bullish, short-term bearish bias on the dollar yen to see a potential squeeze up to retest 146.70, which is the 50-day moving average that is acting as a resistance as well. So as long as the price didn't break above 146.70, very likely the dollar yen is still evolving within a medium term downtrend phase. Okay, so i.e. for today, still maintaining that short-term bearish outlook on the dollar yen with a tighten 144.90 short-term pivotal support resistance level, pardon me, short-term pivotal resistance level 144.90 with the next support level to watch will be at 142.20 in the first step. Other Asia Pacific currency will be the Aussie dollar. So Aussie dollar did a bullish reaction of that 66.70 short-term pivotal support level. Almost retested it during the European session yesterday, but managed to shape a V-shaped rebound. RSI also managed to shape a higher low as well. So all in all, we will start to see a bit of what I call short-term bullish momentum resurging back into the dollar, the Aussie dollar pair. So with that, still maintaining that short-term bullish outlook using 66.70 as a short-term pivotal support level. Price action got to clearly break above 67.70 to give it more to actually see a further potential up move to retest the next intermediate resistance at 68.35, which is the minor swing high of last Friday, what you call it, last Tuesday swing high. Okay, only an hourly close below 66.70 will invalidate this short-term bullish outlook to see the extension of this minor corrective decline to test the key medium-term support zone, which is the confluencing at 66 figures slash 65.70, that confluence with the 50-day and the 200-day moving average, and as well as the medium-term ascending trend line that is in place since 26th of October 2023 low. All right, net still maintaining that short-term bullish outlook on the Aussie dollar 66.70 short-term pivotal support level. Kind of an upside trigger level will be at 67.70. Right, so that's pretty much sum up for the FX market. So still maintaining that bullish, that bearish outlook on the dollar. All right. Now, major stock indices. So let us start with the Hang Seng Index first. So on the Hang Seng Index or the Hong Kong 33, so what we could see over here is that 16,100 pivotal support that was almost tested yesterday before it did a rebound. The price actually started to rebound over here as well, and the RSI has started to exit from the oversold region. So with that, I'll be using 16,100 as a pivotal support level. A break above 16,500, which is close to the downward sloping 20-day moving average, potentially could actually kickstart another round of minor corrective rebound to retest this intermediate resistance zone of 16,950 slash 17,160. We saw confluence with the downward sloping 50-day moving average, and as well as the minor swing high of last Thursday and last Friday. However, if we start to see an hourly close below 16,100, then we will start to see another, we call it a very weak movement on the Hong Kong 33 to test the next support level at 15,500. And bear in mind, 16,100 is very important. As long as price action managed to stay with this level within this week itself, I mean, there could be some messy movement around this level, but we need to have a weekly we call it a weekly gauge whether price action to manage to close above or close below this 16,100 level. Why is it important? Because if we were to look at the longer term chart of the Hong Kong index, the Hang Seng index, this 16,100 confluence with this long-term circular ascending trend line that is in place since the Asia financial crisis, August 1998 low. Okay, that highlighted over here. Okay, then now what's next for the US? Okay, before I go to the US benchmark indices, let's take a look at Japan. So Japan, previously last week we were bullish, so we expect the price action to squeeze up and retest the top of this range over here, which is 33,825 level. So the price action of Japan has been trading in this ascending triangle range since the high of 24th of November. Okay, so this is like an ascending triangle. So now it really hit the top of the range. And what we could see over here is that the RSI, the hourly RSI has started to retreat from a key resistance at the 82 level. It started to actually come down from the overbought zone as well, below 70. So what we could see at this point in time, right, there could be another round of what I call a retracement for the Nikkei 225 or the Japan 225 to actually trade back towards the 20 and the 50-day moving average again within this ascending triangle configuration that is in place since 24th of November high. So using 34,000 as my key short-term pivotal resistance for today, flipping back to a short-term bearish outlook within an evolving ascending triangle range configuration with the first support level to watch at 33,540. A break below it exposes the next support at 33,310, which confluence with this 20-day moving average as well. Only hourly close above 34,000 short-term pivotal resistance will invalidate this minor, we call it corrective pullback scenario within its medium-term ascending triangle range configuration to kickstart a bullish breakout or a start of an impulsive up move towards the next resistance level at 34,200, followed by 34,400 on the Japan 225. So since right now it's at the top of the range with the RSI exhibiting bearish element, the hourly RSI bearish element, so we'll be flipping to a bearish bias to actually look out for a potential corrective slide within a minor ascending triangle range configuration as long as 34,000 short-term pivotal resistance is not surpassed with 33,540 followed by 33,310 as the short-term support level to watch for the Japan 225. US indices, the Nasdaq 100 rallied as expected and hit our short-term support level, short-term resistance level at 16,580 slash 16,500 that we highlighted yesterday. So now the RSI has already is right now at this grossly extreme overbought level in the short term. We could see over here. Okay, so potentially, right, there could be some signs of a pullback coming into play later on when the European session started. So potential pullback level will be at 16,580 slash 16,500 level. So if you look at the PBoC retracement, taking into account of yesterday's sharp push up, it confluence with the 23% and the 38% PBoC retracement. So all in all, right, I don't want to use this level so tight as a short-term pivotal support level in any signs of a potential pullback. I'll be using 16,420 instead. This is much more of a clearer graphical level that was tested. previously resistance breakout now turns into a pullback support level. So as long as 16,420 holds any potential minor pullback later on, given the fact that why there's a potential risk of pullback, because of the grossly extreme overbought level that is being met on the hourly RSI. So 16,420 tighten key short-term pivotal support level. It need to hold in any potential pullback for today for the Nasdaq 100 to resume this ongoing bullish short-term bullish bias towards the next intermediate resistance at 16,800, followed by the all-time high area at 16,990. Only an hourly close below 16,420 will invalidate this short-term bullish outlook to see another round of choppy corrective decline to test the next support level at 16,160, which is also confluencing very closely with the upward sloping 50-day moving average. Wall Street 30. Okay, so this is the US Wall Street 30. So Wall Street 30 over here is that price action also did a short move, push up, and now it's coming very close to the all-time high area at 36,800 level, which is the minor range. Very obvious, it's a minor range resistance that kept the price action since 29th of December. So all in all, right, we will be using, there could be a chance of a pullback as well, very similar to the Nasdaq 100. Okay, potentially the pullback level could be at this level at 37,500 level. So I'll be using the slightly below it, which is corresponding with the 20-day moving average, acting as a support now at 37,380. So 37,380, if you do the PBoC retracement of yesterday's swift up move up, it also correspond with the 76.4% PBoC retracement, slightly below the 61.8%. So as long as any pullback is managed to hold the 37,380 short-term pivotal support level, potentially we could still maintain that short-term bullish outlook towards 37,800. A breakout above this level takes up much higher to a higher high, because do not forget the medium-term uptrend phase still remains intact on the major benchmark stock indices towards 38,100 will be the next resistance level to watch. Only an hourly close below 37,380 could actually negate this short-term bullish outlook to kickstart another round of choppy minor corrective decline to retest 37,170 in the first step. So 37,170 is something like a lower limit of this range configuration that is in place since 28th of December. So you could see very clearly this is a minor range support level at 36,170, previously held on the 15th of December and the 21st of December. So i.e. maintaining that bullish outlook in any potential pullback, as long as this pullback didn't surpass below 37,380, potentially the US Wall Street 30 could still remain in a short-term bullish potential, in a potential short-term bullish dynamic. German 30, lastly, so for the German 30, what we could see over here is that price action managed to hit that resistance level that we highlighted as well, 16,790. So I would not want to, because it didn't surpass this level and also still remains below the pullback resistance of this former minor ascending trend line support level that is in place in 7th of November low. So with that, I'll be still using 16,110 as a short-term pivotal support level. As long as this level holds for today, a breakup above 16,790 potentially exposes us the minor range resistance that is in place since 14th of December at 16,970. Only an hourly close below 16,610 level will invalidate this short-term bullish outlook to see another round of choppy corrective decline to retest last Friday's swing low at 16,440. A break below it exposes 16,300. So i.e. still maintaining that short-term bullish outlook on the German 30 index in any pullback, as long as this pullback didn't surpass below 16,610 level short-term pivotal support. Okay, so that's pretty much sum up for the major indices. We will still maintain that short-term bullish outlook with except the Japan 225, where we expect a retracement back down towards the lower limit of its medium-term ascending triangle range configuration that is still in play. All right, now WTI crude oil. So West Texas oil has a very messy, choppy movement again. Price action broke below 17.90, our short-term pivotal support level, and after that, it managed to shape a higher low. The RSI also managed to exit from the overbought, oversold region. So with that, very unclear configuration right now with wild swing around the 20-day moving average. So we will actually have a more neutrality stance for WTI crude oil price until much more we call it a much more known positive, a much more clearer price action development take shape. So neutral between 68.90 and 72.40 for today on the West Texas oil. Then we have lastly will be the spot go. So for spot go over here, XAU/USD price action managed to actually test that 50-day moving average and start to shape a higher low. And if you look at the price action while it's doing this lower low over here, the RSI now has starts to show a higher low instead at the oversold level yesterday. So yesterday there's actually a bullish divergence signal being flashed, bullish condition being flashed out on the hourly RSI, giving us a bit of comfort that this minor corrective decline from the high of 28th of December all the way to yesterday's US European start of the US session low, that downside momentum is more or less been dissipated. So I'll be using 2015 adjusted short-term pivotal support level maximum/2000 as my key short-term pivotal support level, not resistance, short-term pivotal support level to maintain that short-term bullish outlook on the go. So in first step, it got to recapture 2038, which is the 20-day moving average that was taken out yesterday, now turns into a pullback resistance, which is also this minor congestion area over here. A breakout above 2038 potentially could see a retest on last Friday's swing high at 2060. So still maintaining that short-term bullish outlook on spot gold, given the fact that of this bullish divergence condition that's being flashed out on the hourly RSI yesterday. As long as 2000 short-term pivotal support holds, break up above 2038, exposes 2060 in the first step. Only an hourly close below 2000 level could invalidate this short-term bullish outlook to see the continuation of this minor corrective decline towards the next support level at 1990/1975, which also confluence with the 200-day moving average, and as well as the minor swing low of 12th of December and 13th of December. So that's pretty much sum up with the short-term technical outlook for today. And very quickly, what are the key economic data to look out for ahead of today trading session? So today will be Tuesday. So today will be a rather quiet day ahead. So there is not much of a key economic data releases, except for the European unemployment rate, Eurozone unemployment rate later at 6 p.m. Singapore time. So other than that, US, we have no much of a key economic data releases as well. Okay, so with that, that's pretty much sum up for today's Daily Dose of Market Insight. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.